So I'm back. Hi guys, I'm back with another video. So I know it's been a minute way too long. As you all know, we're in quarantine now, so I have no excuses but to make videos. So I thought a good one would be mortgage jargon. There's a lot of key terms that mortgage lenders use or people who are on the mortgage ladder use that everyone in the general public may not be familiar with. So I thought it would be a good idea for me to do like a glossary of key terms. We know the Bank of England rate has dropped. So now that interest rates are at 0.1%, it's probably a good idea to have a look at whether it's a good time for you personally to get onto the mortgage ladder. I think it's probably best for you to speak to a mortgage advisor about that. But yeah, if you are looking to get onto the ladder or you think it's the right time for you, then these are the type of terms that you should understand. Just a quick note, I am CMAP qualified. I do have the qualification to give mortgage advice. However, I am not giving you mortgage advice in this video. I'm simply defining some terms that I'm familiar with. And yeah, I hope you guys find it really helpful. Don't forget to subscribe and turn your notifications on because, you know, I'm not exactly reliable with this. So it's better that you get notified when I upload a video. So it's probably best to start off with what is a mortgage. So a mortgage in layman's terms is just a loan secured on a property. So it can be secured on a residential property, it can be secured on a commercial property. In my job, I work with commercial properties. So that's things like shopping centres, office buildings, warehouses, things like that, mortgages on those type of properties. Whereas a mortgage that you as an individual will be looking to get is a residential mortgage. And we'll define that in a minute, but a mortgage, that's what a mortgage is. It's a loan for you to purchase a property, and it's secured on a property, meaning that if you fail to pay, if you default on your mortgage, the bank has the right, or your lender has the right to repossess that property and sell it essentially. So that's what a mortgage is. So two key terms that you should understand are capital and interest. Capital is the amount you are borrowing, whereas interest is the cost of the borrowing. So if you were to want to get a mortgage on a house that's worth 200k and you're doing a 90% mortgage, so the bank is borrowing you 180k, the capital amount is 180k. Interest on that may be 1.9% or something like that, and that's the cost of borrowing determined by the bank, the lender that you're going to. So that's the difference between capital and interest. So that is key, because if you have a repayment mortgage, then you're paying down the capital as well as paying the interest on the mortgage you're getting. So after 2 years of having that fixed rate, if you were to get a fixed rate, we're going to define fixed rate shortly, but if you were to get a fixed rate, then after 2 years, your capital amount may be 175k. So you're paying down the amount that you borrowed as well as paying interest on it. That's a repayment mortgage. Sometimes you can have an interest-only mortgage, and that's obviously in the name. You're only paying the interest. The 180k that you've borrowed from the bank is outstanding for the whole term of the mortgage. So if you took out a mortgage for 25 years, in 25 years time, you will still owe the back 180k, even though you're paying them interest every month. Buy-to-let mortgages are designed for landlords who intend to rent out a property after purchasing it. Two other key terms that you'll hear a lot are freehold and leasehold. Freehold is when you own the property as well as the land is built on. So usually houses, like terrace houses, semi-detached houses, detached houses, those are usually freehold properties, right? You own the property, you own the land it's built on. Whereas flats are usually leasehold properties. Okay, so with a leasehold property, you own the property, you own the flat, but the land that it's built on is owned by someone else, and you have a lease on that land. So you essentially pay ground rent to the person who owns the land. That can be any amount. It really depends on where you're buying the property. It varies, it really does vary. I can't give you an amount. A leasehold property, you don't own the land that the property is built on. and that's usually the case with flats. Sometimes it can be houses. It's very rare. I feel like it's really rare, but most of the time it's with flats. With flats, however, you and the other people in the flat can come together to purchase the freehold of the property. It's really complicated to explain, but I know some people who live in flats and actually do own the freehold, so it's not all flats, it's just most flats, I would say. So a fixed rate mortgage is when you set the interest rate for a certain amount of time. Usually it's from 2 to 10 years. I don't feel like I've heard of any products that last more than 10 years. There may be, I'm not quite sure. But yeah, you set the interest rate for 2 to 10 years. So my product at the moment is set for 2 years. When it comes round to choosing a new product, I'll probably set it for maybe 5 or 3, just because interest rates are so low. So yeah, I'll probably do that. The alternative to a fixed rate mortgage is a variable rate mortgage, and that's a mortgage that goes along with your bank's standard variable rate that is set by the bank. Every mortgage product in a way tracks the Bank of England base rate, but that's the lending price for the bank itself. They will obviously put a margin above that. So the standard variable rate is usually what you roll off to when your fixed rate product is finished. So if you don't renew or set another fixed rate by the time your mortgage product ends, then they will put you onto the standard variable rate automatically. Some people may choose to stay on the standard variable rate until they make up their mind. It's way more expensive than getting a fixed rate, so you may want to look into changing that if you are currently rolled off your fixed rate and paying standard variable rate. An agreement in principle lets you know if you can have a mortgage, and if so, how much that lender will let you borrow from them. It's usually just a soft check, so it's not guaranteed that they'll give it to you. You still have to get your full mortgage offer, but it's essentially saying if you meet all of the other requirements, we'll give you this amount of money. A mortgage illustration or a key facts illustration basically just states all the key terms of your mortgage, and your lender is supposed to send that to you just so you understand all the terms of your agreement, your loan agreement, your mortgage agreement. So it's supposed to be nice and simple, and everything is easily laid out for you to understand, and you know the cost of your borrowing. So exchange of contracts, or when you exchange contracts, it's essentially the swapping of signed documentation. Your solicitor will arrange it, and that's the point in which your deposit has to be paid. That's when you're bound to buying the property, and at that point you will lose your deposit if you back out. Any other point in the process you can back out with no repercussions. Well, you'll probably have to pay your solicitors some fees for the work that they've already done, but anything else, you're not legally bound to buy the property, whereas when you exchange, you are. Completion is when everything is finally complete. You're allowed to move into the house. It is legally your house. Everything is done. All the mortgage process is finished, and it's your house to move into. A remortgage is when you arrange a new mortgage on your current property. So you currently already own the property and you're just getting a new rate with a new lender or something like that. That's you remortgaging the property. Equity, I think this is a key one. Equity is the proportion of the property that you actually own, right? That's not indebted to somebody else, like the bank, right? So if you took out a 90% mortgage, like I used in my example earlier, 180k you owe to the bank. That 20k is your equity. That is the amount that you actually put in and you own, right? In the future, your property may go up in value, and if you have a repayment mortgage as well, the amount that you owe the bank will go down, so your equity will increase. So there's 2 ways that your equity can increase. It can increase by the property going up in value, or it can increase by you paying down the amount that you owe the bank. So that's the way you can have increased equity. Some people release equity from their house, and when you do that, you're taking out some of the money that you actually own within the house, right? So if my house went up in value from 200k to 210k, and I owed the bank 175k after 2 years because I've paid some down. I had a repayment mortgage, let's say. These are not actually my mortgage, and my house is not worth 200k. I'm just giving an example. So yeah, so now you owe the bank 175k, your house is worth 210k. You now have 35k of equity within the house, right? You may remortgage and go back to the LTV, we will define LTV, of 90% again. And then when you do that, you'll take out the 15k that you now have extra from when you originally bought out the house, right? Before you had 20k equity, now you have 35k equity. You want to go back to the 20k, so you want to release that 15k. Some people will release that 15k and use it to go on holiday, use it to improve their house, use it for anything they want basically, but that's essentially usually what people use it for: home improvements, holidays, something like that. Or to maybe to use it to go and buy another house, like put it down as a deposit on another house. So I mentioned equity release. There are two ways that you can release equity from your house. You can do it through a further advance, or you can do it through remortgaging. When you do it through a further advance, it basically is a top up on your current existing mortgage with the same lender. So you can release equity through the same lender by doing a further advance as an additional loan onto the mortgage that you've already taken out, or you can do it through your remortgage process, which I already explained earlier. You just increase your LTV as you move on to the new lender, and you can release equity that way. So an LTV, I feel like I've said this in another video before, but an LTV is loan to value. It's the amount you borrow in relation to the value of the house. So if you've borrowed 180k and the house is worth 200k, then the LTV is 90%. Okay, so it's all you have to do is do 180,000 divided by 200,000, and that makes 90%, or times by 100, it will make it 90%. So that is your loan to value. And the higher your LTV is, the more risky you are as an individual to lend to, because obviously the bank has put in most of the money for the house. You only have a small amount of equity within the house, right? So if you hardly put in any money, then how likely are you to keep the house in good shape or continue to pay? Because really you're like, well, really it doesn't matter. Like if I lose it, I lose it. I didn't really put anything in. The more money you've put into it, the more likely you are to look after it, the more likely you are to repay, because you don't want the house to be repossessed, right? So the lower your LTV, the less risky you are to the bank. So if someone over 17 is going to live with you but is not on the mortgage, so they're not paying for anything, they're not going to be on the mortgage, they may have to sign something called a consent to mortgage, and it essentially means that they have no rights to the property. They're waiving all their rights to the property. If as an adult your parents have bought a house or you've moved house, then you probably had to sign it. Your parents have probably made you sign something like that. You probably didn't realise it was happening, but you would have had to sign one. In this process, you'll probably have a conveyancer, and that's basically your solicitor. It's the person who organises the change of title from the seller to you, the buyer. Yeah, they're essentially your solicitor. They do all the legal work behind you buying a house. They do all the checks of the house, the property checks and all those sorts of stuff. So it's essentially your solicitor. So stamp duty is one of the taxes that you have to pay when you purchase a house. It's a government tax on house purchases. Its amount depends on whether you're a first-time buyer, whether it's your main residence or not. That will vary the amount that you have to pay, basically. Okay guys, so that's the end of the video. I hope I explained everything clearly. If not, leave a comment down below and I'll try and explain it better. Or if I missed any terms out that you want to know the definition of, please leave a comment down below. Don't forget to subscribe and put your notifications on, and I'll see you in my next video, guys. Stay safe. Bye.